So, there's this recent analyst report on the Canadian telecom giant Telus, and it paints this really fascinating picture of a company in a, well, let's say a tricky spot. We're going to break down what's really going on behind the scenes.
And this whole situation really boils down to one single, kind of confusing question. It really gets to the heart of the problem here. How on earth can a company be adding new customers, but at the same time actually be losing ground on revenue? Let's unpack that.
I mean, if you just glance at the numbers, they look pretty solid. In the third quarter, Telus brought in a respectable 82,000 new wireless customers. But as this analyst report shows, that success is kind of masking a much bigger problem that's lurking just beneath the surface. What's happening is that Telus is getting squeezed. It's caught between two really powerful forces that are putting immense pressure on its main business, basically forcing it to fight a war on two different fronts. You see, for years and years, the Canadian market was pretty much dominated by the big three. But then, in 2023, a new national challenger, Quebecor, jumped into the ring, and they came in with a government mandate to compete aggressively on price. That completely changed the game.
And you can see the direct impact of this new competition right here. Telus's average revenue per user, or ARPU, which is basically how much money they make from each customer every month, it fell by 3%. That's what happens when you get forced into a price war. That's the number that takes the hit. But that's not the only thing. The second pressure point is coming from a bigger economic shift. A government policy for less immigration means the entire pool of potential new customers is actually shrinking. So now you've got more companies fighting tooth and nail over fewer people.
Okay, so facing this intense squeeze from both sides, how is Telus responding? Well, the company isn't just sitting back and taking it. It's rolling out a pretty specific three-part plan to try and navigate these choppy waters. So here's their battle plan. First, they're going to lean into their biggest advantage, which is their fiber network. Second, they're doubling down on profitability by getting really aggressive with cost cutting. And third, they're placing some big and, kind of risky bets on totally new businesses outside of the telecom world.
Let's talk about that first move, leveraging its fiber network. This is their ace in the hole. Telus has invested a ton of money into upgrading its old copper network to a cutting-edge fiber optic system. I mean, think of it like replacing old rusty water pipes with a superhighway for data. It gives them a massive edge in internet speed and reliability. And while they're leaning on that network advantage for the long term, that second pillar, managing costs, is already paying off. Get this. Even with revenue under pressure, Telus managed to expand its profit margin by 2 full percentage points. That shows some serious discipline. All right, now for the wild card in their strategy. Telus is pouring a lot of money into areas that have, nothing to do with telecom. We're talking health tech, agriculture technology, and even security. It's a really bold move to try and find brand new ways to grow.
But it's not without risk. As the analyst for Morningstar puts it, these ventures have a high degree of uncertainty. The potential upside could be huge, for sure, but there's also a very real chance they could just drag down the company's overall returns. It's a big gamble. So all of this, the market pressures on one side, the company's big strategic response on the other, it sets up a classic debate for investors. It's the story of the optimists, the bulls, versus the pessimists, the bears. The bull case is pretty simple. They're saying Telus's amazing fiber network will help it win the internet war, and those big bets in health and ag tech, they'll eventually pay off and create massive new revenue streams. The bear case, it's the total opposite. They argue that Quebecor's price war is just going to keep hurting sales, and those non-telecom ventures are a risky distraction that could end up torching a lot of money. So, with these two completely opposite views, what's the final verdict from the analyst report? What does the long-term picture actually look like for Telus? The analyst lays out a really crucial timeline here. While this intense price war is expected to keep going for several more years, there might be a light at the end of the tunnel. See, a key government mandate runs out in 2029. After that, Quebecor will have to use its own more expensive network, which should, in theory, finally ease some of this pricing pressure across the whole industry. And this long-term view brings us to the bottom line. While the market has really punished Telus's stock price, the analyst believes its fair value is actually a lot higher, around $30. So the final assessment? Despite all the short-term pain, the stock is seen as undervalued. So we're left with the one central question for Telus and for anyone thinking about investing.
Is this strategy, relying on a superior fiber network while diving into completely new industries, is it a brilliant long-term play? Or is it just a risky distraction from the tough competitive reality of its main business? I guess only time will tell.